Thank you, everyone, for joining Beyond the Numbers, exploring the drivers of investor returns. I'm Bob. I got Nick and Ryan here with me as well. Ryan's here for the tech, and Nick will be here for some of the commentary. So it should be a good conversation tonight. I will say that I'm really excited about this one. This, for me, really dives into a lot of the reasons why we do the things that we do as advisors. And so I'm excited to talk about it. So, Nick, thanks for being here.
Yeah, it's gonna be awesome. I know
Yep.
the title of this is Beyond the Numbers. We are gonna hit y'all with some numbers, but we'll try
Yeah.
to balance those things out. So
Yep. Yep. And I got my Browns gear on because we got the draft tonight. So hopefully the Browns don't screw everything up, but we shall see. So, just to kind of go through the agenda here for this evening, we already did the introductions, but we're going to talk about what drives returns and diving into those different factors for everyone, what we do to plan for those and around them, try to bring it all together. And of course, throughout this entire evening, as always, please just ask questions. Ryan and Nick will be keeping an eye on the questions and we'll pop in if they're relevant at the moment, or if we have to go back, or we can hold them for the end, whatever makes sense. So please just feel free to pop in and ask questions so that we make this as interactive as possible and have some fun. So, the way we want to kick it off was just kind of the overarching question of what is the largest determinant of investor success? And oftentimes the answers to these are things like, what mutual fund manager or ETF manager we pick, or fees. People may think stock picking or picking the right stocks has the biggest impact on your success as an investor. Timing, time in the market, asset allocation, all of these are good guesses, are good thoughts, but there's been a whole ton of research on what are the positive influences or the potential negative influences on investor returns. And through our partnership with Altruist, they allowed us to share some of their research. And so that's what we're going to be basing a lot of this off tonight. So when we look at this as a whole, really the largest determinant of investor success, or the biggest delta that we can control, is our behavior as humans more than anything else. And the reason that I'm so excited about this is because it is my true belief that we can help control those behaviors by doing really thoughtful planning, by knowing and understanding our clients at a deep level. And by doing that, if we can help you accomplish your goals better just by helping control the behaviors, we can do as much as we can, outside of the markets, of course, to get you where you want to go. So we're going to talk about a lot of these here today, but I really want to focus to start on behavior and the reasons behind it, the drivers, and a lot of the biases that we have as humans. Um, so before we get into some of the different biases, I just want to touch on some of the research. So there are just listed here, there are all kinds of studies, but there are 7 listed here that show the impact of poor investor behavior over extended periods of time. Now, these are annualized return detractors if we have bad behavior, which we'll talk about the different biases and things we have to protect from. But of all the different studies, best case scenario, bad behavior only loses you 1%. Worst case scenario, upwards of 4.5 to potentially 6.5% for the most active traders for some of these different studies. If you want insight into some of these different studies, let us know. We can give you the research, but this is kind of the crux of it. And the reason it's so important is if we make the wrong decisions at the wrong time, it can have a massive impact on our returns over what can be a really great period of returns. So all of you may have seen something like this before. I love these charts. I think they're really helpful just in understanding how important it is to not miss the best days in the market. Things like, Wednesday, what was that, April 9th, Nick, or something like that, when the market was up 10, 12%. So if we had $100,000 in the S&P from 2005 through 2024 and just sat on it, it would be $717,000 today. Okay, that's just the numbers. If all we did was miss the best 5 days of the market because we got scared, because we sold out for any number of reasons, if we miss those 5 days, our returns almost get cut in half just from missing those 5 days. And any step we take beyond that, so if we miss the best 10 days, 328. If we miss the best 15, 249, 20, 25. The theory, the idea is the same. And I think the interesting thing about this, Nick, and you know this as well as I do, the best days tend to come right by the worst days, right? So, it's so easy to get caught up in the emotion of a down market or a kind of a scary situation and want to sell or take action. But charts like this help to us to feel like, hey, if we just stick to the plan and stay the course, we're going to be better off.
Mm. Yeah, I hear clients say like, I just want to sit it out for a week or something. You're like 5 business days. I'm like, man, those can be some very expensive days of sitting it out. And I know, like we want to give you peace of mind and all of these things. And of course, we can never promise or never predict the future exactly when the market's going to rally, but it's usually at the moment where like you feel the most pain and as an investor is usually right when everyone else is feeling that same level of pain and things kind of start flipping the other way. So yeah, on that note, I know we've looked at this chart before, but before when we looked at it, it went over like 100 years. So this one's a little bit more relevant. It's the last 20, 30 years or so. Yeah, 20 years. And so it just highlights all of the different crazy calamities we've had since 2008. And every single time that we encountered one of those headlines, it was a headline that was in the media nonstop on the news cycle of talking heads opining over their opinions and things they don't know and all that. And the other thing though too is that in most of these cases, it was the first time that any of those had ever happened, right? So like that's always the headlines, like this has never happened before. This time's different, and that's like a trap of a mindset that we want to help y'all escape.
Mhm. Yep. And I think that, the interesting part here too, I love this on the right side, Nick, just about investing at the worst times. So
Mhm.
if, you invested at kind of the bottoms or these different terrible areas, how much you'd still get as far as return, right? So sometimes our bias against wanting to do things, that aren't comfortable, can cost us, right? So that's why having a good plan and sticking to our plan over time is going to be the best approach. So I'm gonna take over for a little bit here because I'm gonna talk about the qualitative side of this. And anybody that's into psychology or likes anything like that, I think you'll enjoy these next few slides. And then I'll let Nick take over and talk more on the technical stuff. But of course, Nick, you can jump in when and where it makes sense. But these are the different behavioral biases that we have in investing. These aren't all of them. This is not an exhaustive list, but these are some of the things that we have to combat in order to make sure that we are staying on the right direction and staying focused on why we're investing and ultimately what we're doing here. So, as humans, we have these biases. I'm not sure which one it is, to be honest with you, right? But we have these different multiple biases, and we can take those and we can talk about them in the context of both the human condition and investing and what we need to do to work against them. So, um, if you're not familiar with different cognitive biases, we'll kind of go through these together. I'm going to give you an academic definition of each and then just talk about how it impacts us as investors and generally as humans as well. So confirmation bias, that's basically looking to seek out information that confirms a belief that you already have. So, we may look for things that say, hey, this stock is a good stock pick, and just ignore everything that says it might not be a good stock pick because we just want to confirm what we already believe is fact. So we see this all the time in our lives, and it's especially true in investing. And we have to make sure that, and quite honestly, as we go through these are things that we as advisors have to understand and have to work against as well, right? So we try to do things and have conversations as a team so that there's not just one of us sort of running with the ball and being subject to these different biases. Um, Recency bias, and I'm going quick through these because I want to, one, be mindful of time, and two, of course, can always ask questions or go back if we need to revisit anything. So recency bias is another bias we have, and this is a tendency to give more weight to recent events, and undervalue things that happened kind of further in the past, because we believe that what happened more recently is more relevant, right? That what's going on with Trump and everything that he's doing, from kind of the trade wars with China. We're only focusing on that and not thinking through, hey, there's been a lot of times that we have had trade wars over the years, and we have worked through them and come up with a strategy to navigate them. But when it's recent, it feels stronger. It works more towards our bias. And again, we have to work against this, right? And again, in a different example, an investor sees a stock surge, right? And they're like, hey, it's going to keep surging. I'm going to jump in, but we're not, we ignore all the other moving parts to it. Another bias that we have, over extrapolation bias, right? It's kind of taking the patterns that we've seen and thinking they'll persist in perpetuity, right? So we saw a lot of this, Nick, when the market was down that 3%, those 3 days in a row there in early April, that
Mhm.
everybody's like, or not everybody, but a lot of us emotionally feel like it's never going to end, right? Like, when is it ever going to go back up? And we think that it's just going to continue in perpetuity. In reality, these things happen, right? We have these times that we're going to have down markets, and on the flip side, up markets, right? Like, I don't want to focus too much on the negatives right now, even though we're in kind of a volatile market. But the same thing can be thought through to, 2023 and 2024, when the market was just going up and up and up. We just think, hey, it's just going to keep going up and up and up, and it never goes down. And we have to make sure we're combating those biases.
Mhm. Yeah, on the downside to that one too, like the thing that always helps me get through those really tough days and even scary days that we had in April, where the market's down 5+% in a day, or multi days of down 5%. It's like, listen, if it kept falling at this cadence, like Microsoft, Apple, Amazon, like they would be worth nothing in a month from now. It's like they're going to be worth something in a month from now. All right, like it's the pain in these big moves. They are definitely scary, and they're painful for sure, and we're going to navigate those. But like trying to overcome the over extrapolation bias has been a big one that we see for folks a lot, where they just want to like just stop the bleeding. It's like, I know I
Yep.
feel you. Yeah.
Yep, absolutely. And that's what we're here for, though, Nick, right? Is to understand that these are just human conditions that we all have, that we all go through. They're just emotions, because at the end of the day, we're all emotional beings. And as much as we want to make investing about the numbers and about charts and graphs and all that stuff, at the end of the day, it comes down to, how does this impact us emotionally? And how do we stick to our plan so that the charts and the graphs work in our favor, right? And plan through some of these human conditions. So,
Mhm.
um, next one's anchoring. I want to go through this quickly because I like the next one as it relates to what we've seen here recently, Nick. But anchoring is a tendency to rely on kind of the initial piece of information. We tend to anchor to a spot, right? We say, okay, the Dow is at a certain level and it should be at this level, right? Or even this, I go back to, I had a conversation with, a colleague here recently, and I remember, this is me, about 10 years ago, that somebody told me Apple was a good stock to buy. And I looked at it, and its market cap at that point was like 200 million or $200 billion, right? And I was like, okay, well, $200 billion, there's no way it can go to $1 trillion or $2 trillion. Why would I invest? Because what's the upside here? So I was anchored to this idea that the market cap was the driver, right? When in reality, that there's no kind of basis for that. So, a lot of times we see this, people buy a stock for $100 or whatever the number is. And if it goes down, we anchor to that $100. We think, well, it was worth $100 before. So it should go back to that at some point. So I'm just going to hold on to it, or I'm going to buy it here because it should go back, right? So when past prices have literally no bearing on what the future prices will be. The next one is loss aversion. And I go back to this with the over extrapolation bias because they tie in together so much. Like Nick, you said, stop the bleeding. We as humans have a tendency to feel more pain from losses than we get from similar or even outsized gains, right? So as we were, humans, tens of thousands of years ago, and, we were in a cave and we had to protect ourselves, right? Like we have this innate understanding that we need to protect the risks, right? Because protecting the risks gets us to see another day. It's not about going out and getting extra strawberries or whatever we may have wanted at that time, right? So we have this aversion towards loss. And again, this is not just an investment bias. This is not just, clients don't like losing money. This is a human condition that we have to understand. So, we understand this as advisors. We understand this as a team. We understand how painful it is to see our accounts go down. But what we want to do is make sure that we're thinking about, our clients and their 2030 selves, right? Their 2035 selves versus just kind of the loss that we may see in the short run. Okay. Next bias, something called tail risk fixation. And this ties to we tend to focus on extreme events, even if they have an extremely low probability of happening, right? So black swan events, right? Any, the Great Depression as an example, right? Like what if it's the next Great Depression, something like that. But even in the real world, people don't like to fly on airplanes because there is this tail risk of a catastrophic event happening. Um, on the flip side, though, we tend to gamble for the exact same reason, just in the opposite direction, right? The possibility that we win the lottery is almost zero, right? Like it's playing the lottery or not playing the lottery, your odds are almost the same of winning, right? Which is crazy. But we are fixated as humans on this kind of tail risk or tail reward. And so we will, try to buy that next hot stock. We'll try to find the next Tesla or Bitcoin or something like that, as opposed to just getting steady, reliable gains in our investments. We also have a bias towards hyperbolic time preferences. So this is a tendency to prefer smaller immediate rewards versus longer term rewards. I look at this as kind of like the patience bias, right? Like, anybody, if you go to the gym, if you work out, sometimes it can be difficult, sometimes it can be painful, but we do it because over 20, 30 plus years, that's going to keep us healthier over time. I promise you, it's way more fun. I know it's way more fun to just, drink beers and eat wings. But the long-term payoff of doing the right things, having the right habits over time is what gets us to where we want to be. So we tend to focus on the short term versus the long-term payoff of things. And a couple more here, but I like to touch on all of these. Number 8, they call it the IKEA effect. And this is a tendency to place a higher value on something we have built, even if it's not justified to continue to do it. And again, I don't want to pick on Nick here, right? But I'll call out Nick. These are the reasons that we have investment committee conversations, right? These are the reasons that, even as a team, we want to make sure that even what we're building for clients, we're always looking at how can we improve it? How can we make sure that we're doing the right things for our clients? Because, how this plays out in the real world is, hey, I designed it, so I'm not going to change it, right? And we want to make sure that, in our core as balance is simple, explainable, and aligned with your values. We want to build these things for you and build them together. So we kind of use this IKEA effect to our benefit so that we don't abandon it in the bad areas. But also understand that we can't just stick to it just to stick to it, right? We have to be mindful of ways to continue to improve these things over time. And the last bias, this is a bonus bias I wanted to throw out there, is something called the action bias. And I think this is extremely poignant or helpful at this point in time with what's happening in the market. And it is the tendency to favor action over inaction. And it has a lot to do with just reflexes, automatic response, impulse, right? Like we as humans, you get dropped into cold water, you immediately want to jump out, right? If anybody cold plunges, right? Like, it's just the human condition that we want to do it. But we've seen a lot of this where people want to act when the markets go down. And there are things that we will do, and there are things that we have done that I'll let Nick take over and talk about here shortly. But we don't want to act just to act. We want to do that because there are reasonable things that help put us in the best direction. Quite honestly, folks, sometimes the best action is no action. I used an example earlier today of if we're driving on the road and we start to hydroplane, hopefully all of our drivers out there know that you don't try to turn the wheel, you don't try to slam on the brakes, you just do nothing. You kind of hold the wheel straight and you wait for the car to catch back up so that it can straighten itself out, and then we go from there. Oftentimes inaction is the best solution, even though action may feel better. So taking these biases, I think the most important thing about what we can do about it is just understanding that we all have these biases, right? Each and every single one of us, me, Nick, Ryan, everybody on this call, everybody that may watch it at some point, your mother, your grandmother, your kids, we all have different biases. So understanding those and creating a personalized investment and planning approach. There's a typo in there, planning approach. We're doing some woodworking, right? Doing planning, but planning approach. So we want to make sure that the investments align with our values, so that we have that IKEA effect that we use for good. But also we can do some planning decisions during this, and Nick will talk about tax loss harvesting. I've talked to a lot of folks about Roth conversions, income timing decisions. There are things we can do that help combat or help us to personalize and go against these biases. Sometimes we can use them for good, right? Like setting up a habit or setting up a consistent reaction to things that may happen in the market can help us make sure that we are taking advantage of market conditions as opposed to letting our behaviors dictate them. And we think the most important part, and what we always try to do here, is have honest and open communication. And this goes both ways. So please always reach out to us as a resource, as a sounding board, as you're thinking through and you're like, man, I might have a bias here. Bob, Nick, let's talk about it, right? Let's kind of go through how this is impacting me and kind of what I'm thinking about. So there's an amazing read, awesome book. I absolutely love this book. I actually have it here right next to me because every now and then I pick it up and read it. Um, and it talks a lot about the psychology and our biases and behaviors when it comes to money. And what we're offering up to anybody that's on the call now, may watch it in the future. If you want us to send you a copy of this book, we are happy to do it. I mean, we have no skin in the game for doing this. I just think it's such a great read and ties in so much to what we find is important as advisors and as kind of your teammates and team members. We'll send you a copy. So Ryan, I think you can drop a link in there. So if anybody wants to fill that out and get a book sent their way, let us know. We'll send it to you. But either way, we'll put it into our follow-up email tomorrow as well. So that's enough of me talking. I'm going to turn it over to Nick to talk about the other contributors to performance. We're going to start with direct indexing and tax management and kind of work through all these different areas pretty quickly here because we do want to make sure we wrap up. But Nick, go ahead and take it over for some of these here.
Yeah. Thanks, Bob. You crushed that. The that book is honestly one of my favorites. It does such a good job just cleanly articulating the pitfalls we have and like why we feel the way we do about money and in times of stress. So 10 out of 10, highly recommend that book. So going back to the performance attribution here and tax management. So we've talked about this before, especially in times of market volatility just creates more opportunities, right? Like I'm a glass half full kind of guy. And, when the market hands you lemons, we make lemonade. And so Tax loss harvesting is one of our favorite things to implement for people, especially with taxable accounts. And this is something that we already do for all of our clients automatically. If you have a taxable account with us, we're considering this, we're doing all these things on your behalf. And the reason why is because we live in a world where taxes are guaranteed and market returns are not. And so this is one of the things where we can, like Bob always says, control what we can control. This is one of the best ways that we can put our best foot forward to help y'all with that. So keep going on to the next
Yep.
one. So
So, and Nick, you did
yeah.
a whole, okay.
Yeah, of course. Yeah. So I did a whole webinar on tax loss harvesting specifically. You're not getting webinar 2.0 right now. We'll divert you to that other one. But just very quickly, I say tax loss harvesting, and most people probably don't know what that is off the top of their head. So to put it simply, stocks have three choices, right? Like they can go up, sideways, or down. I know lately it might only feel like down, but they do other things too. And when and when that happens, we have a choice to make. And so scenario one is we can do nothing, right? So that the action bias, even doing nothing, is still a decision to stay invested, and you might catch it back up, and it might just bounce back perfectly the way that we wanted. Or in that moment when things are stressed and markets are down, we can use a strategy called tax loss harvesting, which is where we sell out of a stock at a loss. So this is something that we put money in and then it goes down. It's like, okay, well, now we have what's called an unrealized loss. And what we do then is realize that loss, AKA sell the thing that we bought and replace it with something that has a suspiciously similar exposure. And there's over 5,000 different exchange traded funds today. There's tons of them, thousands, amazing, almost as many funds as there is stocks. So there's plenty of ways to do this, both with individual stocks or with ETFs, and we do both, quite frankly. So it just depends on the case. So, all right. So speaking of stocks, tax loss harvesting paired with direct indexing, we're just hitting you with all the industry jargon here. So direct indexing, instead of owning a fund that, let's just say the S&P 500 for round numbers, you can buy the S&P 500, which is a basket of the 500 biggest stocks, all in one fund. So one line item, and if you look under the hood, there's 500 stocks. Alternatively, you could just go out and buy those 500 stocks yourself. But there's pros and cons to that. So one of the biggest pros to doing that is that there's plenty of years when the market is up, and this doesn't even include 23 and 24, but just over the last time too, it's held the same. But over the course of when the market's up 20+%, there's over half the stocks are down by 50% or meaningfully amount down. I think it says like 10 to 15%. Almost all of the stocks experience a 10 to 15% dip at some point in the year. And so that being said, even in the biggest up years, if you just bought the one fund, it goes up 20%. You're like, yay. But if you did the direct indexing, your whole portfolio will still go up by that much. But we were capitalizing on all those wiggles along the way too. So
Yep. All the
more
individual
on the
stocks.
webinar. Yeah.
Yep. Yeah. So, and again, this is something that if you were not able to watch the tax loss harvesting and direct indexing webinar, I highly recommend that you ask us. We can send you a link to go watch it on demand. But it was super helpful, and it dives into this in much more detail, as well as this one, the capital gains distributions as it ties to mutual funds.
Yeah. So in addition to tax loss harvesting, direct indexing, just making sure that we're using the most tax efficient vehicle itself to invest makes a huge difference. We are at this point in time where ETFs or exchange traded funds have really blossomed. They're shown their beauty, but there's still a huge portion of the industry that we see, and a lot of clients come to us with actively managed stock mutual funds inside of a taxable account. And that's like one of the main things that we target and try to walk away from, is because even in the years when markets are down, those things on average will kick out a 7% capital gain distribution. So Imagine a year where like your stocks are down. This was picking on 2022. And then you still had taxes to pay out of your depressed portfolio value. So like that's worst case scenario. We want to not have that happen for any of our clients. And direct indexing flips that on the head almost completely. Doesn't have this issue at all, but instead you get capital loss distributions even in up years. So it's the inverse benefit.
Yep. And I think the overarching piece there, right? Just I'll skip past portfolio selection and just kind of go here.
Mhm.
But, you know, doing these things, doing these two in tandem and just overall just managing taxes for our clients, right? It's such an important part of what we do, right? And for anybody that's gone through, we've done some Halista plan things or different tax planning, right? We want to make sure that when we're talking to you or to anybody that we're fortunate enough to work with, it's not just focused on one thing. It's focused on so many things because there's so many ways that we can hopefully add value, and that's what we want to be here for. So the next big section is overall just portfolio selection. And I think this is one that most people understand is a big driver, right? Like putting together a plan, understanding our risk management, understanding how we should take cash flow distributions, then picking the security or asset allocation, right? Like all this stuff ties together, right, Nick?
Mhm. Yeah, exactly. We're not going to hit you over the head and going into each one of these super specifically, but just in general, everyone likes a good pie chart or donut chart, right? Like, and we like to show this to folks because it's not only like determining like, okay, Mr. and Mrs. Smith, you're supposed to be a 60-40 for your household. It takes it, or we take it at least one step further, and we say, okay, of the equity exposure of the 60, where does it make sense, depending on your type of account and tax status, to take that equity exposure, and where does it make sense to have that 40% parked? And so we look at this, across the household, but get even more particular with what's called asset location. And that by itself, you don't need to go back, but that by itself, asset location says it'll add roughly 75 basis points or 0.75% of alpha over time. So
Yep.
being smart with that is one of the first things that we like to help folks with too.
Yep. Yep. And then the last one we have to talk about is rebalancing. And this is
Mm.
something that we've been doing here recently. And I'll let Nick kind of walk through. We've got what I think is a really interesting sort of extreme example, right? But it just shows the power of rebalancing and sticking to a plan over time. But then we'll tie it into what we've done here recently for all clients and given the market volatility that we've seen over the past couple of weeks. So
Yeah.
I'll let
All
you
right.
run with this, Nick, and just tell me when you want me to go to the next slide.
All right, perfect. So, yeah, so 1994, we go back in time in the time machine here. Which stock would you invest in, Apple or Starbucks? And I should make you write it down so you're committed, but it's okay. We'll just
We have no way to make sure
we have
everybody
no way
sticks
to
to it,
validate
right?
that. It's okay, scout
But I
system
think
here.
most
All right.
people would say Apple, right? Like that would probably be my guess there. And
Mhm.
looking at the chart
Yeah,
very clearly,
Apple, and this is from 1994 to 2012, snapshot of time here, but Apple up 5,000 something percent, Starbucks up 3,000 something percent. So not bad, right? Like we'd be happy with either of those. But the Apple folks would be a lot happier than the Starbucks folks, right?
and I think I'm just going to stop for a second, right? Because I think charts like this are so interesting because you know, knowing what we know today, and goes back to like the behaviors and the biases and, like looking back, like hindsight bias, right? Like now that we know this information, it's so obvious that we should have held Apple and Starbucks, right? But like, look at some of these drops for Starbucks, right? For Apple, even, right? These massive losses, even here in 2000, you'd have been sitting at a 500% gain and it went down to almost zero, right? At certain points in time. So, the patience to stick with this is so difficult over time. And so I just think it's interesting we know that these are good stocks and we should have held them since 94, but it's really hard to stick with them through time. So sorry, Nick, I'll let you get back on.
Yeah, no, that's perfect. So, we're on the rebalancing slide, not the buy and hold section, right? So let's talk about rebalancing here. So what if you did Apple and Starbucks, all right? And we're gonna say like roughly 50-50 each, call a little bit more in Apple. And then we rebalance that portfolio quarterly. So that's also assuming, we're not adding money and it's a like a qualified account, not a taxable account. So we're not dealing with capital gains or anything like that. But what about that? What if we were rebalancing these two stocks instead? Okay. Well, as it turns out, the orange line you see there is that blended portfolio of those two things. And as you can see, it's a 9,000% return. It's almost twice as much return that you would have got by actively rebalancing this over time. And this is not day trading or anything like that. But it's being methodical, it's sticking with a plan. And I love this quote. And it's rebalancing is tough, right? Like it's cutting your flowers. You see the thing doing well, and you're naturally going to then have to rebalance it or sell some of that thing that's been doing well and redeploy the capital to things that have not been doing so good, or
And I
might have
think this was
been
a
good, but just less good, right?
Yeah, and I think this is a Warren Buffett quote, isn't it? Even, right? I think he said this to Peter Lynch at some point, or is Peter Lynch
Yeah.
to Warren Buffett, one or the other, right?
Yeah. I think it was Lynch to Warren Buffett. Yep.
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 So, but I just think this is so interesting, right? Like literally the same holdings, the same stocks. And because you stuck to this rebalancing plan, it was astronomically different as far as the return parameters are concerned and the
Mhm.
volatility within it as well. I'll add to that. And so we see this in the real world. We do this with your portfolios, right? In a much more uh, broad sense and diversified sense. But Nick, sorry to steal it from you, but go ahead.
Yeah, no, that's exactly right. So, just to look at this year in particular, like speaking of things, recency bias, things that are top of mind. What's happening now? And if we look at, how a globally diversified portfolio would have been doing, allocate at the beginning of the year versus where was it on like Tuesday or something when I threw this together. How would everything have shaken out? Well, it's like bonds are actually slightly positive for the year, international stocks positive for the year, and US stocks are the main ones that have been down. So even though we started at a 60-40, so like 40% bonds, just from market volatility, if you had done no other trading up till whatever Tuesday was, then that drift alone can cause some distortions on the stock to bond ratio. And so one of our jobs as advisors and what we do for all of our clients automatically is we rebalance. So we manage the risk in down markets and in up markets. So when bonds are doing well, we'll peel off some money from bonds. And usually in that environment, stocks are not doing so great. And so now we have capital, or people like to say dry powder. We have money to use to shift into the stock bucket. And again, we're not like necessarily trying to like perfectly market time this at all. This is more just like risk managing the portfolio. And we don't do this every day, right? Like there's a balance of when it makes sense on the frequency and everything else. But this is something that we do and have done for all of our clients multiple times so far this year, taking advantage of the volatility.
Yeah, and for a lot of folks, if as you're listening to this or kind of thinking through it, you may have seen trades come through. This
Mhm.
is exactly what we're doing, right? Like, well, I say we, but it's Nick, right? Like, working on the trading, doing the rebalancing, making sure that we are keeping the risk where it's supposed to be, but also we're taking advantage of that rebalancing benefit that comes from when it's cutting your flowers and watering your weeds, right? Like that's what we're doing. And, we want to stick with it.
Yep. 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 So, and I love to pick on target date funds because they're so prevalent in our industry and everyone has them in their 401k lineup, right? But rebalancing, so within the target date fund, they do rebalance for you automatically. So that's good. But the way that they're
Ooh.
designed is they're designed to glide more and more conservative over time. And so what we've seen in 2008 and in other, like even in COVID shock and other times, if you're in that like near retirement phase, that fund can be rebalancing more conservative in the worst moments, right? Like markets can be down or dislocated by 20%. And then it's like, oh, well, it's your calendar quarter. It's time to shift it a notch more conservative. It's like, no, wait, like let's not be so robotic with that. And so this is just an easy one to say, like, we are more thoughtful with all of our clients about when we suggest dialing up or dialing down risk. It's not just a robotic process, robo advisor type of answer, right?
Yep.
Yeah.
Yep.
So back to how we invest. I love the funnel, right? Like this is what we love to do. There's I know we've shared this with many of you all before, but if you haven't seen it, this is how we like to and ideally want to just get to know all of you much better. And so that way we can get to that third layer where it's investment ideas that the client understands, trusts, and aligns with their goals. But then also taking it a step further, we want to make sure that the strategy also aligns with your worldviews, biases, and that way you can actually sleep at night and you're comfortable and you have conviction in the things that you're invested in. And so that's a process. And that's also why we don't have just like one investment solution, size fits all for everybody, right? Like we want to acknowledge that there's multiple ways to get from point A to point B, multiple professional diversified ways to do that. And that's why we have a menu of investment choices like we do. So.
Yep. And I go through, and again, I go more the qualitative, Nick's on the quantitative side, right? But that's why knowing and really caring about the relationships that we have with each and every one of you, all of our clients, because understanding the biases that you have, I can name off the top of my head the clients that have some of these biases we talked through that feel them more strongly than others.
Mhm.
And we make sure that we are stepping in front and making sure we're being front and center for when those things come up. Because again, these, a lot of these things have nothing to do with investments. A lot of them have everything to do just with our personalities, with who we are as individuals, as humans. And so, at the end of the day, we want to make sure that we're here for you as humans, as friends, confidants, whatever you want to call us, not just your investment guys or your financial advisor or whatever it may be. So, I know that this was a little bit different of a conversation than maybe we would have thought about. But again, for me, I think it's just such an interesting conversation and an important conversation to have. And the research says, to bring it all together here, the research says that the biggest contributor that I, as an advisor, can have for my clients is helping you to control your behaviors and your biases. And we think about that all the time. Like I can tell you in our conversations as a team, in our, discussions as a team, like how do we make sure we're staying in front of clients and helping them kind of get through the tough times, or not get too excited in the good times, right? And then all the other stuff Nick does a great job of, I think we do a great job of, right? Like this is kind of the table stakes in my mind, but the behaviors are so important. And we wanted to share those with you because the more you understand about them, the better you can kind of just be prepared when those different biases come up. So any questions? Did any questions come up through here? I know this is kind of a tough one to ask questions on, but if anybody has any questions or wants us to talk more about any of the specific biases, or here, let me get back to the performance contributors, any of the different contributors, the research, anything like that, please feel free to ask. And we're happy to talk through any of those. And I told you, Nick, like I know that we were looking at this, presentation prior to, and there's a lot of slides and a lot to talk about. And I know we both talked kind of quick, but we're at 45 minutes, so we got in well under the hour that we gave ourselves. So pat on the back, I think, for both of us, Nick, for not talking too much.
Yeah, it's a good thing we let you lead that. I would have taken way too long. No, that's great. It's great.
Yep. Ryan, did you get any questions that popped in there?
Nothing. Nope. No questions.
Okay.
You guys are too thorough.
All right. Well, that's good. Well, I'm going to go back just to the um, this slide on the psychology of money as we wrap up. So just a reminder, everyone, if you stuck with me through all this and if you found any of this interesting, which hopefully you did, let us know if you want a copy of this book, The Psychology of Money by Morgan Housel. It's an absolutely phenomenal read that really does a great job of talking about why we do what we do and a lot of the kind of basis for our decision making. But let us know if you want a copy. I'll send you one, and I'll sign it or something fancy, right? So,
Just
you know,
devalue it immediately. No, I'm
yeah, immediately devalue it, right?
And can you go to the last slide of this too, Bobby G?
Oh, we got to do
The most important slide.
yeah, got to make sure we put it up there. Our disclosure
There we
slide.
go. All right. All right. Cool.
Perfect. Well, so I think we checked all the boxes then. Thank you everybody for being on this evening. I know the draft is going. I have no idea if the Browns picked yet or who they picked. It doesn't matter. The Browns will never win a Super Bowl in my lifetime. So, I got an Eagles fan and a Broncos fan on the call here with me. So, they can go ahead and celebrate. The Browns will not. But thank you so much for being on here this evening. We're always here for you if you need anything. We look forward to seeing you on our next webinar series, which we're going to talk about cryptocurrency and specifically Bitcoin. So hopefully you're able to join that one in May. We're still working on the date with some special guests, but thank you all for being here, and we'll see you soon.